We are taught that wealth equals security, that once you reach a certain level of financial power, whether you are a Hollywood superstar, a tech visionary, a national tycoon, or a century-old investment bank, you become untouchable. But history tells a very different story. Wealth doesn't make you invincible. It just amplifies the scale of your mistakes. Welcome back to Boring Finance Guy. Today, we are mapping the architecture of ruin. We are analyzing 7 of the most spectacular financial downfalls in modern history, tracking how hundreds of billions of dollars evaporated through greed, hubris, and terrible math. Imagine getting paid $20 million for a single movie. You buy a private jet, 2 private islands in the Bahamas, a couple of European castles, and, just because you can, a real dinosaur skull. Sounds like the kind of wealth that could last forever. Except a few years later, the IRS is demanding millions in unpaid taxes. You're forced to sell almost everything you own, and the internet starts making fun of you for appearing in every low-budget movie imaginable. Your name is Nikolas Page. And despite what most people believe, this isn't just the story of a celebrity who spent too much money. It's a story about leverage, liquidity, bad financial decisions, and how even someone earning tens of millions of dollars a year can end up on the edge of financial disaster. By the late 1990s and early 2000s, Nikolas Page had become one of Hollywood's biggest stars. He had already won an Academy Award for leaving Las Vegas. Then came blockbuster after blockbuster. The Rock, Face/Off, Con Air, National Treasure, Ghost Rider. Studios loved him. Audiences loved him. And the paychecks kept getting bigger. For some films, Page earned around $20 million. During his peak years, his annual income was estimated at somewhere between $20 and $40 million. His net worth climbed to roughly $150 million. For most people, that would be enough to stop worrying about money forever. But Nikolas Page wasn't interested in living like a normal millionaire. At one point, he owned around 15 properties. Luxury homes in California, mansions in Las Vegas, historic properties in New Orleans, a waterfront estate in Rhode Island, 2 private islands in the Bahamas, and not 1, but 2 European castles. He also collected Ferraris, Lamborghinis, and Rolls-Royces. He owned a luxury yacht, a private jet, but the truly unbelievable purchases were still ahead. One day, Page spent about $276,000 on a genuine dinosaur skull. Not a replica. A real fossil. Years later, investigators discovered it had been illegally smuggled out of Mongolia. Page had no choice but to return it. Then there was his copy of Action Comics #1, the very first Superman comic. He paid more than $1 million for it. It was eventually stolen. Years later, it was miraculously discovered inside an abandoned storage locker. He also collected rare artifacts and exotic animals, including an extremely rare albino king cobra. Looking at all of this, it's easy to conclude that Nikolas Page simply went crazy with money. But that's only part of the story. Then came 2008. The global financial crisis hit. The real estate bubble burst. Properties that had looked like incredible investments suddenly lost massive amounts of value. Finding buyers became incredibly difficult. But property taxes, maintenance costs, and loan payments didn't disappear. On paper, Page still looked incredibly wealthy. In reality, he had a serious problem. He didn't have enough liquidity. This is one of the biggest financial traps there is. You can own hundreds of millions of dollars in assets and still run out of cash. Things became even worse when the IRS stepped in. The U.S. tax authority claimed Page owed roughly $6.2 million in unpaid taxes. Cage blamed his financial manager and sued him for around $20 million. The manager fired back, arguing that no financial advisor could save someone spending money at that pace. The truth was probably somewhere in the middle. To recover, Cage began selling almost everything: his castles, his islands, his luxury homes, his cars, his art collection. And at the same time, he started accepting almost every acting role that came his way. If you've ever wondered why Nikolas Page seemed to appear in dozens of low-budget movies throughout the 2000s, this is why. He needed the money. The internet turned him into a meme. People joked that he'd say yes to absolutely any script. Years later, Cage admitted there was a reason for it. He wanted to pay back every dollar he owed. He was determined to avoid bankruptcy. And that's where this story takes an unexpected turn. Because, despite everything, Nikolas Page never filed for bankruptcy. That's one of the biggest misconceptions about his financial collapse. Yes, he lost an enormous fortune. Yes, he was forced to sell most of what he owned. But instead of walking away from his debts, he worked relentlessly, movie after movie, year after year. Eventually, in 2020, he paid off what he owed. And something else happened. His career came back to life. Films like Mandy, Pig, and The Unbearable Weight of Massive Talent reminded audiences that behind all the headlines and internet jokes was still an exceptionally talented actor. Nikolas Page's story teaches a lesson that's surprisingly easy to forget. A high income doesn't make you financially secure. What matters is how much you spend, how much debt you take on, and whether you have enough liquidity when the unexpected happens. Because even if you're making $20 million per movie, you can still end up selling castles just to pay your bills. Kodak is one of those companies that feels like it should still exist in the same form today. Because for most of the 20th century, it basically defined what photography was, and yet it ended up in bankruptcy in 2012. Not because it failed to see the future, but because it actually built it, and then decided not to use it. The story begins with George Eastman. In the late 1800s, photography was complex, expensive, and limited to professionals. Eastman changed that. He introduced roll film and simple cameras with a powerful idea behind them. You press the button, we do the rest. That sentence wasn't marketing. It was a business model. Kodak made photography accessible to ordinary people for the first time. And in return, it created something even more powerful than camera sales, a recurring revenue machine based on film and development. For decades, Kodak dominated photography almost completely. The logic of the business was simple. You bought a camera once, but you kept buying film, and you kept paying for developing photos. So the real profit wasn't in hardware. It was in consumption. Every photo you took meant more revenue for Kodak. This is important because it explains everything that comes next. Kodak was not a camera company. It was a film consumption company. By the mid-20th century, Kodak was enormous. In the United States, it became almost synonymous with photography itself. The Kodak moment wasn't just a phrase. It became part of everyday language. If you wanted to capture a memory, you didn't say, "Take a photo." You said, "Make it a Kodak moment." At this point, Kodak wasn't competing in a market. It was the market. But inside the company, something strange was already happening. In 1975, a Kodak engineer named Steve Sasson built something unusual, a device that could capture images digitally. No film, no chemical processing, just a sensor and a digital file. Technically, it worked, but it was slow, low resolution, and completely unready for mass consumers at the time. So internally, it was treated as an interesting experiment, not a product, and definitely not the future of the company. And this is where Kodak made its most important decision. Not in a dramatic boardroom collapse, but in a quiet, strategic hesitation. Because digital photography had a clear implication. It would destroy Kodak's core business. No film, no developing, no recurring revenue. Just one-time hardware and digital files that cost almost nothing to replicate. So the company found itself in a paradox. It understood the future, but the future was financially incompatible with its present. For a long time, Kodak tried to balance both worlds. It continued dominating film photography, while slowly investing in digital imaging, printers, and adjacent technologies. But it never fully committed to cannibalizing its own business. And that hesitation created a delay that would become irreversible. During the 1990s and early 2000s, the industry shifted faster than Kodak did. Companies like Canon and Nikon embraced digital cameras. Sony pushed consumer electronics into imaging. And Kodak, despite its early research, was still heavily tied to film economics. The core issue was simple. Digital photography removed the need for film entirely. And without film, Kodak's main revenue engine disappeared. For a while, this didn't look like a crisis. Kodak was still profitable, still recognized, still a global brand. And that's one of the most dangerous situations for any company. When decline starts, but cash flow hasn't fully collapsed yet. Because it creates the illusion that there is still time. Then came the final disruption. Smartphones. The iPhone in 2007 didn't just improve digital photography. It removed the need for standalone cameras for most people. Photography stopped being a separate activity. It became a feature inside another device. At that point, Kodak wasn't just losing film. It was losing the entire consumer camera market. The structure that had supported Kodak for over a century was now gone. And what replaced it was not just a smaller market. It was a fundamentally different one. Low marginal cost, digital distribution, and no recurring consumables. Kodak's business model simply did not exist in that environment. By the late 2000s, the financial pressure became unavoidable. Revenue declined. Costs remained high due to legacy operations. Attempts to shift into printers and digital services never replaced the lost scale. Debt accumulated, and restructuring became the only option left. In 2012, Eastman Kodak Company filed for Chapter 11 bankruptcy protection in the United States. This is important to understand correctly. It was not liquidation. It was a legal bankruptcy process designed for restructuring. Kodak did not disappear. Instead, it sold a large part of its digital patent portfolio, shut down or reduced core legacy businesses, reorganized its operations under court supervision, and attempted to survive as a much smaller company. It was, formally, a bankruptcy, but also a transformation forced by survival. After bankruptcy, Kodak continued to exist, but in a very different form. It shifted toward printing technologies, industrial applications, and licensing its brand. The Kodak name still exists today, but it no longer represents what it once did. It is no longer the center of global photography. It is a remnant of it. What makes Kodak's story so interesting is that it wasn't a failure of awareness. Kodak saw digital photography early. It even invented key parts of it. The failure was structural. A company built on recurring revenue from film could not easily transition into a world where film no longer existed. Because in doing so, it would have had to destroy its own business model before a new one was ready to replace it. Kodak didn't lose because it ignored the future. It lost because it couldn't afford to fully accept it. Have you ever lost money on an investment? Maybe a few $100s. Maybe a few thousand. Now imagine losing $70 billion, not spending it, not having it stolen, just watching it disappear as the market crashes. That's exactly what happened to Masayoshi Son. For a brief moment in the year 2000, he was the richest person on Earth, at least on paper. Then, within months, almost all of his fortune vanished. It's widely considered the largest personal wealth loss in history. And somehow, it wasn't the end of the story. Masayoshi Son was born in Japan to Korean immigrant parents. From an early age, he was obsessed with business. As a teenager, he moved to the United States and studied economics at the University of California, Berkeley. Even before graduating, he had already made money as an entrepreneur. One of his first successes was an electronic translator that he licensed to Sharp for around $1 million. Instead of stopping there, he kept building. In 1981, he founded SoftBank. Despite its name, SoftBank wasn't originally a bank. It started as a software distributor, connecting software developers with retailers across Japan. But Son had much bigger ambitions. He wasn't interested in building just another company. He wanted to build an empire around technology. He often talked about planning not for the next quarter or even the next decade, but for the next 300 years. That mindset shaped everything he did. Throughout the 1990s, SoftBank expanded aggressively. It acquired companies, invested in internet startups, and placed bets on industries that barely existed. Many people thought Son was reckless. Others thought he was a visionary. Then came one decision that would define his entire career. In 2000, Masayoshi Son met a relatively unknown Chinese entrepreneur named Jack Ma. The meeting reportedly lasted less than an hour. Alibaba had almost no revenue, no proven business model, very little that traditional investors would call safe. But Son wasn't interested in spreadsheets. He later said he invested because he believed in Jack Ma himself. SoftBank invested around $20 million. Today, it's considered one of the greatest venture capital investments in history. But at the time, nobody knew that. Around the same time, the internet boom reached its peak. Technology stocks were exploding. Investors believed the internet would change everything, and they poured money into almost anything with a .com attached to its name. SoftBank owned stakes in hundreds of technology companies. Its stock price skyrocketed. Masayoshi Son's personal fortune rose so quickly that, for a short period, he was actually wealthier than Bill Gates on paper. It was one of the fastest wealth creations in history. And then, everything collapsed. In early 2000, the dot-com bubble burst. Technology stocks crashed. Companies that had been worth billions suddenly became nearly worthless. SoftBank's stock price fell by about 99% from its peak. As the shares collapsed, so did Son's fortune. An estimated $70 billion disappeared. To put that into perspective, that's more than the annual economic output of many countries. No lottery winner, no billionaire, no investor in history is known to have lost more personal wealth in such a short period. Newspapers declared the internet dream dead. Many believed SoftBank would never recover. But here's something important. Masayoshi Son didn't actually go bankrupt. This is where many people misunderstand the story. His fortune was mostly tied to the value of SoftBank shares. When the stock price collapsed, his net worth collapsed with it. It was largely a paper loss. He still controlled SoftBank. He still owned valuable investments. And, most importantly, he refused to sell. That decision changed everything. While the world had written off the internet, Alibaba kept growing. Year after year, the company expanded across China. Then, internationally. When Alibaba finally went public in 2014, it became one of the largest IPOs in history. SoftBank's original investment multiplied thousands of times. What had started as a $20 million bet eventually became worth well over $100 billion. Almost overnight, Masayoshi Son returned to the list of the world's richest people. The comeback was almost as unbelievable as the crash. Most people would have become far more cautious after experiencing a loss like that. Not Masayoshi Son. He doubled down. In 2017, SoftBank launched the Vision Fund. With roughly $100 billion, it became the largest technology investment fund the world had ever seen. The fund invested in companies like Uber, DoorDash, Arm, Coupang, OYO, and WeWork. Once again, Son was making enormous bets on the future. Some of them paid off. Others became spectacular failures. WeWork alone turned into one of the biggest startup disasters in history. Then came the technology downturn of 2022. Vision Fund reported tens of billions of dollars in losses. Critics once again claimed Son had lost his touch. It almost felt like history repeating itself. So what should we make of Masayoshi Son? Was he a genius? Or simply one of the luckiest investors ever? The truth is probably somewhere in between. Many of his investments failed. Some lost billions. But a single extraordinary decision, the investment in Alibaba, generated returns so massive that it overshadowed almost every mistake. His story also reminds us of something most people forget. There's a huge difference between losing money on paper and actually going bankrupt. At one point, Masayoshi Son lost around $70 billion, the largest personal wealth loss ever recorded. Most people assumed it was the end. Instead, it became just another chapter in one of the most remarkable investing careers in history. Mike Tyson's life is one of those stories where the numbers almost stop making sense. A kid from Brooklyn with no real future becomes the youngest heavyweight champion in history, makes hundreds of millions of dollars, lives like a king, ends up bankrupt anyway. And the strange part is that none of it feels like a straight line. It feels more like a rocket that went too fast and eventually burned out. Tyson grew up in Brownsville, Brooklyn, one of those places where trouble isn't something you fall into. It's just the environment. By his early teens, he had already been arrested multiple times. He was small, angry, constantly in fights, and already known to the police. Boxing wasn't a dream. It was basically a last exit before prison. That exit came in the form of Cus D'Amato. D'Amato didn't just train Tyson. He took him out of his environment completely. Tyson moved into his house. Daily routines, discipline, structure, obsession with perfection. D'Amato didn't try to fix Tyson's aggression. He aimed it. The result was immediate and almost uncomfortable to watch. Tyson turned professional at 18, and then started destroying people. Most fights didn't last long enough to build tension. Sometimes it looked less like competition and more like collapse. At 20 years old, he became the youngest heavyweight champion in history. Suddenly, the kid who was supposed to be a statistic was earning main event money. And that's where the story stops being about boxing and starts being about everything that comes after money arrives too fast. At his peak, Tyson was earning tens of millions per fight. Pay-per-view numbers were massive. He was everywhere. Magazines, TV, headlines, global attention. Over time, his total career earnings are estimated at around $400 million. But the way that money entered his life mattered less than the way it left. Because it didn't leave slowly. It leaked, exploded, and disappeared in different directions at the same time. Tyson didn't live like a wealthy athlete. He lived like someone trying to physically experience what unlimited money feels like, before it stops. He bought multiple mansions that required full staff just to operate. He had a garage full of luxury cars, many of them barely driven. He wore jewelry that wasn't just expensive. It was intentionally attention-grabbing, almost theatrical. But the most absurd part wasn't even the things. It was the events. At one point, he threw a birthday party where luxury cars were part of the entertainment. Not display pieces, prizes. Guests were literally entering lotteries for vehicles like it was a game show. Except the prize pool was parked outside in the driveway. There were also stories of Tyson keeping Bengal tigers as pets, with trainers and handlers on payroll, because normal security dogs apparently weren't enough for the vibe. And all of this sat on top of something even more expensive. People. Large entourages. Friends, advisors, assistants, hangers-on, many of whom were being paid, directly or indirectly, from Tyson's income. It wasn't just lifestyle inflation, it was lifestyle expansion, without breaks. But the real financial damage wasn't only caused by spending, it was caused by lack of control. Tyson's career was surrounded by managers, promoters, and advisors. Some were competent, some weren't. And over time, the system around him became as expensive as the lifestyle itself. Legal disputes, fees, commissions, and financial mismanagement quietly drained millions. Then, personal life added another layer of pressure. His marriage to Robin Givens ended in a highly public divorce that wasn't just emotionally destructive. It was financially heavy as well. So even in years where he was earning enormous sums, the net result wasn't accumulation. It was leakage. Then everything stopped. In 1992, Tyson was convicted of rape and sentenced to prison. He served around 3 years. For a boxer, that's not just downtime. That's total financial silence. No fights, no PPV, no endorsements, just disappearance from the income stream. And yet, when he came back, the market still remembered him. Because names like Tyson don't fade easily. His return to boxing was immediate business. Millions per fight came back into the picture. The rematch with Evander Holyfield became one of the most infamous moments in sports history. Not because of boxing skill, but because Tyson bit Holyfield's ear and got disqualified. The fight turned into global controversy overnight. But financially, it still worked. Controversy didn't reduce his value. It often increased it. And still, by the early 2000s, the structure finally gave way. In 2003, Mike Tyson filed for bankruptcy. Despite roughly $400 million in career earnings, he was over $20 million in debt. Taxes, creditors, obligations, all catching up at the same time. It wasn't a dramatic single collapse. It was more like a system that had been unstable for years, finally reaching its limit. What actually caused it is less cinematic than people expect. It wasn't one bad decision. It was a combination of things that all scale badly when money gets big fast. A lifestyle that assumed income would never slow down. A financial structure that never matured. Constant legal and personal expenses. Too many dependents on the payroll. And a career where earnings are massive, but not stable. Tyson didn't run out of money suddenly. He ran out of structure. What makes the story interesting is what comes after that moment. Because Tyson doesn't disappear. He doesn't stay as a cautionary tale frozen in time. He reappears in completely different contexts. Comedy films, pop culture cameos, a surprisingly successful reinvention in entertainment, a podcast audience that treats him less like a boxer and more like a personality. Even later exhibition fights. Not as a return to dominance, but as controlled nostalgia. If you zoom out, Tyson's story isn't really about rise and fall in a clean sense. It's more like watching someone get access to extreme resources at an age when there's no internal system to handle them, and then slowly building that system years after the damage is already done. The strange part is that the bankruptcy isn't even the final chapter people remember. It's just one of the middle scenes. The story keeps going anyway. Vijay Mallya's story doesn't really collapse in a dramatic single moment. It collapses like most big corporate failures do, slowly, structurally, and then all at once. And the center of that collapse was Kingfisher Airlines. At its peak, Mallya wasn't just a businessman. He was building a vertically branded empire. Alcohol with Kingfisher beer, sports with Formula One's Force India, and aviation with Kingfisher Airlines. The idea behind the airline sounded simple. India's growing middle and upper class would pay more for a premium flying experience. But the economics of aviation don't care about branding. They care about load factor, fuel cost, aircraft utilization, and cash flow timing. And Kingfisher got all of those wrong at scale. From the beginning, Kingfisher Airlines was structurally expensive. Mallya acquired an existing airline, Air Deccan, and merged it into a hybrid model, part low-cost base, part premium repositioning. That created an identity problem immediately. The airline had low-cost pricing expectations from legacy Air Deccan customers, but high-cost service standards from Kingfisher branding. So it sat in the worst possible position. High cost base, but weak pricing power. The cost structure was brutal. Aviation fuel in India was heavily taxed and volatile. Lease payments for aircraft were in foreign currency. Maintenance and operations were dollar-linked. Meanwhile, ticket prices were constrained by competition from aggressively efficient low-cost carriers like Indigo and SpiceJet. So Kingfisher was constantly squeezed. Costs in US dollars, revenues capped locally. That mismatch alone made profitability extremely difficult. But the real problem was what happened next. Instead of shrinking or restructuring early, Kingfisher expanded. It added aircraft. It increased routes. It pushed branding harder. All of this was financed through debt. Large loans were taken from Indian banks, many of them state-linked institutions. But critically, the loans weren't supported by stable operating cash flow. They were effectively used to cover operating losses. So the airline entered what is known as a negative cash conversion loop. Operations lose money, debt covers losses, debt increases interest burden. Interest increases total losses. Times more borrowing is needed. At that point, the business stops being an airline and becomes a refinancing machine. By 2010 to 2011, the situation became operationally visible. This is where the collapse stops being financial theory and becomes real-world breakdown. Kingfisher started facing delayed salary payments to staff, unpaid fuel bills to suppliers, aircraft grounded due to lack of lease payments, reduced flight schedules, shrinking fleet availability. Airlines depend on continuous liquidity. If fuel suppliers or leasing companies stop trusting you, the network collapses quickly. And that's exactly what started happening. At the same time, banks began tightening pressure. Loan repayments were being delayed or restructured repeatedly. Interest accumulated. Credit ratings dropped. New financing became harder to secure. So instead of refinancing at reasonable terms, Kingfisher was forced into short-term survival mode. That is usually the point where corporate collapse becomes irreversible. By 2012, the operational system broke. Aircraft were progressively grounded. Routes were canceled. The airline's AOC, Air Operator Certificate, effectively became meaningless because the fleet wasn't operational anymore. In practical terms, Kingfisher Airlines stopped being an airline. It became a company with debt, employees, and no functioning core business. And here's the key point most summaries miss. Kingfisher didn't fail because it had too much competition or low margins. It failed because it violated three core aviation survival rules at the same time. 1. Cost base higher than competitors. 2. No flexible capacity reduction early enough. 3. Debt used to fund operations instead of growth. Once those three align negatively, collapse is almost mathematical. When the AR line finally shut down operations, the debt didn't disappear. It snapped into focus. Banks were left exposed to billions in unpaid loans. And because many of those banks were partially state-linked, the issue became not just corporate failure, but political and legal pressure. That's the moment Vijay Mallya himself became the central figure in the story. After the shutdown, Mallya left India and moved to the UK. From that point, the story stopped being about aviation. It became about debt recovery, extradition, and financial accountability across jurisdictions. Indian authorities accused him of financial mismanagement and loan default connected to Kingfisher Airlines. Mallya's position remained consistent. This was a business failure in a difficult industry, not criminal intent. But by then, the financial damage and political visibility made neutrality impossible. What makes this case interesting isn't just the bankruptcy mechanics. It's the mismatch between three layers: brand perception, luxury, success, good times; financial reality, losses, debt spiral, refinancing dependency; operational reality, airlines slowly becoming non-functional. Those three layers drifted apart over years, and when they finally collided, there was nothing left to stabilize the system. Vijay Mallya didn't lose a company in a single bad year. He lost control of a structure where every part depended on continuous external financing to survive. Once that financing stopped working, the entire system collapsed, almost instantly. And the king of good times became, very quickly, a case study in how fast perception can survive reality, until it suddenly can't. Collapse of Evergrande. The debt machine. Evergrande didn't collapse like a normal company. It was one of the largest real estate developers in China, and one of the most heavily indebted property companies in the world. This wasn't a slow decline in profitability or just losing out to a competitor. It was the spectacular, managed unraveling of a system that had been holding itself together with debt, unrealistic expectations, and a blind faith in constant growth. We are talking about a real estate giant that, at its peak, operated over 1,300 projects across more than 280 cities, housing roughly 12 million people. The company achieved a market valuation of $47 billion and controlled assets worth $353 billion. Yet beneath this glittering facade lay a ticking financial bomb. With liabilities ballooning past $300 billion and eventually topping $320 billion, Evergrande became the most heavily indebted property company in the world. To put that into perspective, that is more than the entire annual GDP of Finland or Pakistan. How did a single company build a tower of debt this massive? To understand that, we have to look at the man who engineered the entire machine, Hui Ka-yan. Hui Ka-yan wasn't born into the world of high finance. He was born in Henan Province, one of China's poorest and most rural regions. He grew up around scarcity, in a life where basic infrastructure was lacking, and stability was never guaranteed. He studied metallurgy engineering, not finance, and for a long time he lived a completely ordinary life, working at a steel company. Everything changed in the 1990s. China was undergoing one of the fastest urban transformations in human history. Cities were expanding at an unprecedented scale, and in 1998, The government allowed households to privately buy and sell apartments. A massive surge in housing demand followed as millions transitioned into the middle class. In Chinese culture, property ownership became deeply normalized, often viewed as a strict prerequisite for marriage and financial security. Hui Ka-yan timed this perfectly. He founded Evergrande in 1996 in Guangzhou. His strategy was incredibly aggressive. He strategically acquired land from local governments at favorable prices, often providing upfront payments and setting brutal sales targets for his employees. The timing was flawless. In 2009, he pulled off a successful IPO in Hong Kong, instantly transforming himself into a multi-billionaire and one of the richest people on Earth. A Ponzi scheme on real estate. Evergrande's meteoric rise relied on a business model that was simple, highly effective, and fundamentally dangerous. The core mechanism was a reliance on pre-sales. Evergrande didn't build apartments using its own cash reserves. It sold them before they were even built. Buyers would pay full deposits or even secure entire mortgages for apartments that existed only on blueprints. What happened to that cash? Instead of using it to finish that specific construction project, Evergrande immediately used the proceeds to acquire new land, unlock more bank loans, and launch the next project. The cycle became a perpetual motion machine. Sell early, build later, borrow more, expand faster. As long as property prices kept rising, the system worked beautifully. But analysts later noted that this continuous reliance on cash from future projects to pay for current obligations bore a striking resemblance to a classic Ponzi scheme. Worse still, intoxicated by cheap credit, Hui Ka-yan began aggressively diversifying into unrelated industries. Evergrande poured billions into an electric vehicle startup aiming to rival Tesla, theme parks marketed as Fairyland to compete with Disney, a bottled water company, and even owning a major professional football club, Guangzhou FC. None of these ventures turned a meaningful profit. They were all funded by a mountain of growing debt. The entire machine rested on one fundamental assumption: home prices will keep going up. But underneath the surface, the market was severely overheating. Speculation reached a fever pitch. Tiny apartments in Shanghai were fetching London or New York prices, despite local wages being drastically lower. Furthermore, developers built for a projected population boom that didn't exist, partly because local governments relied on faulty, over-counted population data. Empty concrete towers began dotting the skyline. Ghost cities built for buyers who would never arrive. By 2020, real estate accounted for roughly 30% of China's GDP, and a staggering 70% of Chinese household wealth was tied up in property. Beijing knew this was an unsustainable systemic risk. To force a deleveraging, President Xi Jinping ordered tight regulatory thresholds known as the Three Red Lines policy. It set strict financial limits on developers, measuring their debt to assets, debt to equity, and cash to short-term debt ratios. Evergrande failed all three. The consequences were immediate and catastrophic. The company could no longer freely borrow its way out of its problems, and for a system built entirely on continuous refinancing, losing access to new loans meant the structure was bound to snap. By 2021, Evergrande's liquidity crisis spilled into the public eye. The company had immense paper wealth in land reserves and half-built projects, but assets are not cash. You cannot pay short-term bank interest or bondholders with a collection of unfinished concrete husks. Construction ground to a halt. Suppliers weren't paid, and millions of middle-class families realized they had handed over their life savings for homes that might never be completed. Evergrande had pre-sold more than 1.4 million undelivered homes. This transformed a corporate liquidity problem into a severe social crisis. The market response was a bloodbath. Following a 17-month trading suspension, Evergrande's shares resumed trading in August 2023 and instantly plunged 87% in a single day. Ultimately, the company's market value eroded by 99%, wiping out tens of billions in shareholder value. A final, desperate attempt to protect its U.S. assets by filing for Chapter 15 bankruptcy protection in a New York court did little to stem the bleeding. Finally, the state came for the man at the center of the empire. In September 2023, after several wealth management executives were detained, Chinese authorities officially placed Hui Ka-yan under detention on suspicion of illegal financial misconduct. His personal wealth evaporated, his control was stripped away, and the empire he spent decades building was officially handed over to a state-supervised, managed unwind. So, is this China's Lehman Brothers moment? The answer is complicated. Unlike the U.S. in 2008, China operates a heavily state-controlled banking system. This allows authorities to move liabilities around and use extend and pretend accounting methods to ensure that major banks don't face sudden, systemic failure. There is no outright government bailout for Evergrande or its executives. Instead, parts of the company are being liquidated, projects are being slowly absorbed under external control, and the financial system is forcing a slow, managed bleeding rather than an explosive collapse. But the lesson of Evergrande is a universal warning for the global financial markets. It vividly demonstrates how fragile growth becomes when it depends on a single unhedged assumption that prices will always go up. When leverage moves in the wrong direction, a heavily indebted system doesn't just slow down, it snaps. Hui Ka-yan didn't build a traditional company. He built a machine designed for continuous, leveraged expansion. And when that expansion stopped being possible, there was nothing left underneath to hold it together. When Evergrande collapsed, it was a slow, managed demolition. But when Lehman Brothers fell, it was an overnight detonation that froze the global financial system in a matter of hours. Founded in 1850 as a humble cotton trading business in Alabama, Lehman Brothers survived the American Civil War, the Great Depression, and 2 world wars. By 2007, it had evolved into the 4th largest investment bank in the United States, commanding over $680 billion in assets. But Lehman didn't die of old age. It died of greed, extreme leverage, and toxic debt. And at the helm of this ship was Richard Dick Fuld. Fuld, nicknamed the Gorilla for his intimidating presence and aggressive management style, became CEO in 1994. Under his leadership, Lehman transformed from a conservative bond trading house into a hyper-aggressive risk machine. Fuld wanted to compete with giants like Goldman Sachs, and to do that, Lehman needed to stop just advising on deals. They needed to own the risk. To understand how Lehman destroyed itself, you have to understand the machine they built, the mortgage-backed security, or MBS. In the early 2000s, U.S. interest rates were slashed to historic lows. Wall Street realized they could make a fortune by buying up thousands of individual home loans, bundling them together, and selling them to global investors as high-yielding, safe bonds. But eventually, they ran out of good borrowers. So, the banking system lowered its standards. They started issuing subprime mortgages to people with bad credit, no income, and no verified assets. Lehman Brothers didn't just buy these bundled loans to sell them to clients. Under Fuld's direction, Lehman aggressively moved into the principal investment space. They bought 5 separate mortgage lenders, including subprime giants like BNC Mortgage and Aurora Loan Services. They weren't just securitizing the debt. They were originating it, packaging it, and critically, keeping the riskiest slices, known as collateralized debt obligations, CDOs, on their own balance sheet. By 2006, Lehman underwrote $146 billion in mortgage-backed securities, capturing an 18% market share. They were completely addicted to real estate. The real killer wasn't just the toxic mortgages, it was the leverage. Investment banks use borrowed money to amplify their returns. By 2007, Lehman Brothers' leverage ratio had reached an astronomical 31-to-1. Let's do the math on what that actually means. For every single dollar of their own money, equity, Lehman was borrowing $31 to invest. At its peak, the firm had a staggering $680 billion in assets, supported by a microscopic $22.5 billion in firm capital. When you are leveraged at 31-to-1, your margin of error is basically zero. If the value of your assets drops by just 3.2%, your entire equity is wiped out. You are instantly insolvent. Lehman had built a $680 billion skyscraper on a foundation the thickness of a piece of paper. And in 2007, U.S. housing prices stopped going up. As subprime borrowers began to default, the value of those bundled mortgage securities plummeted. Lehman's massive portfolio of real estate assets suddenly became toxic waste. The first massive shockwave hit in March 2008 when rival bank Bear Stearns collapsed and was panic sold to J.P. Morgan Chase for just $2 a share, backed by the Federal Reserve. Wall Street immediately turned its eyes to the next weakest link, Lehman Brothers. Short sellers began ruthlessly attacking Lehman's stock. Dick Fuld remained stubbornly optimistic, insisting the firm was fine and refusing to sell toxic real estate assets at a discount to raise cash. It was a fatal miscalculation. In the second quarter of 2008, Lehman reported a $2.8 billion loss, its first loss since going public. By September, the stock had lost 90% of its value. Clients started pulling their money out, and other banks stopped accepting Lehman's collateral. The bank had entered a death spiral of vanishing liquidity. It all came down to one frantic weekend, September 12th to 14th, 2008. U.S. Treasury Secretary Hank Paulson and Federal Reserve Chairman Ben Bernanke summoned the CEOs of Wall Street's biggest banks to the New York Fed. The mandate was clear. The U.S. government was not going to bail out Lehman Brothers with taxpayer money. The private sector had to find a buyer, or Lehman would die. Two buyers emerged, Bank of America and the British bank Barclays. But Bank of America backed out to buy Merrill Lynch instead. Barclays was ready to sign, but at the last minute, UK financial regulators blocked the deal, refusing to let Britain import Wall Street's toxic cancer. With no buyer and the U.S. government refusing a bailout, Dick Fuld was out of options. The 158-year-old gorilla of Wall Street had been left to bleed out. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. It remains the largest bankruptcy filing in U.S. history, with Lehman holding over $619 billion in debt. The aftermath was apocalyptic. Because Lehman was a counterparty to trillions of dollars in complex derivative trades, their sudden death broke the global trust machine. Banks stopped lending to each other completely. The commercial paper market, which funds the daily operations of normal businesses, froze solid. The Dow Jones plunged 504 points that day, destroying trillions in global wealth and plunging the world into the Great Recession. If Evergrande was a localized machine designed for infinite expansion, Lehman Brothers was the central nervous system of global finance, poisoned by its own leverage. It taught us the most terrifying lesson in modern finance. When you borrow $31 for every dollar you own, you aren't just gambling with your own life. You are gambling with the entire global economy. When you look at these 7 downfalls side by side, you realize that financial ruin isn't a chaotic anomaly. It follows a highly predictable script. Whether you are an individual spending millions on private islands or an institutional bank leveraging yourself to the absolute brink, the psychological traps are identical. They all fall into 3 distinct categories of financial blindness. First, the illusion of infallibility. This is Nikolas Page, Mike Tyson, and Vijay Mallya. It's the belief that the cash flow machine will never stop pumping, leading to catastrophic lifestyle inflation and unsustainable personal debt. Second, the fear of progress. This is Kodak. It's a multi-billion-dollar empire choosing slow corporate suicide because they were too terrified to disrupt their own existing cash cows. They prioritized protecting the past over owning the future. And third, the leverage trap. This is Masayoshi Son losing $70 billion by over-indexing on tech speculation, Hui Ka-yan building a $320 billion empire on unbuilt apartments, and Lehman Brothers borrowing $31 for every single dollar they actually owned. They all treated debt like a magic wand, completely ignoring the fact that leverage works beautifully in a bull market, but cuts you to pieces the moment the trend reverses. Whether it's a government managing a slow, painful winding down of a developer in China, or a dramatic weekend liquidation on Wall Street, the ultimate law of finance remains completely undefeated. Cash flow is reality. Everything else is just an expectation. When you mismatch your assets and your liabilities, or when you let your ego outgrow your balance sheet, the system doesn't just slow down. It snaps. Thanks for watching, and I'll see you on the next balance sheet.